Imagine looking at your stock portfolio in the year 2035, and the company managing the AI algorithm that tracks your immune system, analyzes your biomarkers, and dispenses your personalized preventative medicine is, well, it's the exact same company that brewed the beer your great-grandfather drank in 1885.
Right, which is just crazy to think about.
It's wild. But today we're doing a deep dive into Kirin Holdings.
Yeah, and it really is one of the most unexpected corporate evolutions out there. I mean, you look at the name and you instantly think of those giant copper brewing vats and, traditional lagers. But what they were building behind the scenes is just entirely different.
Exactly. And if you're holding a traditional consumer goods stock in your portfolio right now, Kirin's restructuring over the last few years is it's a massive wake-up call. You really have to ask yourself, is your legacy stock actually reinvesting for future demographics? Or are they just comfortably riding out their old cash cows until they dry up?
Which happens a lot.
Yeah, too often. So for this deep dive, we're channeling a special Japan stock podcast theme. Our mission today is to dig through a massive stack of Kirin's corporate and integrated reports spanning from 2019 all the way up to 2026 to extract the absolute key drivers impacting their earnings, their growth, and their future valuation.
And we're going to dissect this through the lens of a senior investment analyst. We really need to evaluate their strategic shift from what they call their KV 2027 vision straight through to their newly announced 2035 targets.
Right.
We have to look at how their unique assets actually translate into tangible financial metrics. Things like EPS, earnings per share, their return on capital, and ultimately how all of that actually drives shareholder value.
Because here's the ultimate paradox that hooked me immediately when I was looking at this. How does a 130-year-old Japanese beverage brand successfully become a global pharmaceutical and health science powerhouse?
It's a huge leap.
Right. To understand that, we need a sharp introduction to what Kirin actually is today.
So let's start with their origins, because it actually explains their current structure perfectly. Kirin started in beer way back in 1885, and they officially founded the current company in 1907. But look, if you analyze them today as just a brewery, you are completely mispricing the stock.
Oh, absolutely.
They have deliberately built a highly unique three-pillar portfolio over the years.
Okay, so pillar one is food and beverages, which is obviously their historical core.
Right.
Pillar two is pharmaceuticals, and they operate that under the name Kyowa Kirin. And the third, which is their newest pillar, is health science. And tying all this together is their corporate slogan, "Joy brings us together." But what really stood out in the reports is a core management philosophy they call CSV.
Creating shared value.
Yeah, exactly. Creating shared value. It's this idea that they can solve major social issues like health and environmental sustainability while simultaneously generating economic value.
And that CSV philosophy is critical here. I mean, it sounds like standard corporate marketing fluff, right?
Yeah, it totally does. Just a nice PR slogan.
Right, but they actually use it as a stripped filter for capital allocation, which we'll see clearly when we look at their recent acquisitions and divestments.
But looking at this three-pillar portfolio, I mean, you have beer, you have prescription drugs, and you have health supplements. To a casual observer, this looks like a traditional food company suddenly acting like a biotech startup.
It's a fair point.
Are they just, drifting away from their core competency?
It looks disparate on the surface, sure, but it makes perfect calculated sense when you look at the macro environment. I mean, think about the demographic shifts happening globally, but especially in their home market of Japan. Japan has a rapidly aging population and a shrinking birth rate.
Right, which means fewer young people going out for pints of lager after work. So the domestic volume is fundamentally constrained.
Precisely. Traditional alcohol volume growth in their domestic market is in structural decline. There's a hard ceiling on how much beer they can actually sell. Management recognized that if they wanted to grow earnings, they had to pivot to high-margin sectors where demand was, guaranteed to expand.
And what does an aging, health-conscious population demand?
Preventative health, specialized supplements, and advanced pharmaceuticals.
So they didn't just abandon their core. They realized their core wasn't actually just making beer. Their core was the science behind making the beer.
Exactly. And this is the crucial mechanism to understand. Because Kirin spent a century mastering how yeast and bacteria interact in brewing beer, they possess incredibly advanced bioreactors and fermentation technology.
Wow, okay.
Yeah, so they repurposed that exact same biotechnology to cultivate specific bacteria and complex molecules that could be used in medicines and supplements. They're doing what they've always done, which is fermentation, just applying it to a vastly more profitable sector.
Which brings us to the actual mechanics of how they built this new portfolio. Because to understand their current financial strength, we have to look at the pretty painful restructuring Kirin just went through. It wasn't just a matter of waking up one day and deciding to formulate medicine.
Not at all. Between 2016 and 2018, Kirin aggressively cleaned house. I mean, they initiated a massive structural reform to free up capital.
Just shedding dead weight.
Yeah, they sold off low-profit assets, most notably Brazil Kirin, which had been the significant drag on their overall margins. And they also did a lot of hard operational work fixing their lion beverage business down in Oceania. They were essentially stopping the bleeding, generating cash, and just leaning out.
And that leads to a really significant geopolitical and ESG milestone in their recent history, which is the Myanmar exit. Now, I want to be super clear to you listening. We are looking strictly at the source material and the financial and strategic impacts of this event. We aren't taking any political sides here.
Right, just analyzing the business impact.
Exactly. But following the 2021 military coup in Myanmar, Kirin decided to exit their joint venture there due to severe human rights concerns.
Yes, and the process of actually getting out was incredibly complex. It took 2 years of intense negotiations. It finally culminated in a complete withdrawal in 2023. And financially, it resulted in a significant impairment loss of roughly 19 billion yen.
Let's pause on that term for a second. An impairment loss of 19 billion yen. What does that actually mean for the company's underlying cash flow?
That's a great question because people see that and panic. An impairment loss doesn't mean you are writing a check for 19 billion yen today.
Okay.
When a company buys or builds an asset like a brewery in Myanmar, they put it on their balance sheet with the expectation that it will generate a certain amount of cash over the next decade.
Right.
When a catastrophic event happens and management realizes that future cash is never coming, accounting rules dictate that you have to take the hit right now on paper to reflect the new reality. It reduces your reported profit for that year, but it's a non-cash charge. The actual cash is already gone.
I have to push back a little on the strategy here, though. Taking a 19 billion yen hit in Myanmar and then turning around and spending massive amounts of capital to buy up supplement companies like FANCL in Japan and Blackmores in Australia, I mean, that feels a bit whiplash-inducing. How does an analyst view that kind of extreme pivot?
It looks aggressive, I'll give you that, but it actually demonstrates extreme capital discipline. Why does the Myanmar exit matter so much to institutional investors? Because it proves that management's strict adherence to their CSV principles and their risk management protocols are actually real.
They weren't just bluffing.
Exactly. They stuck to their guns and abandoned a high-risk, low-synergy asset in a volatile region, even when it hurt the bottom line in the short term.
So they essentially took the pain up front to cleanse the portfolio?
Yes. And then they took the cash they were generating globally and went entirely on the offensive. Buying FANCL gave them a massive established footprint in Japanese cosmetics and supplements, particularly with preservative-free products.
And then Blackmores.
Right. Acquiring Blackmores gave them a dominant, highly trusted natural health brand across the whole Asia-Pacific region. They deliberately traded unpredictable geopolitical risk for highly predictable, high-margin health growth.
So now we know what they bought and sold, but let's look at where they operate today and how global macroeconomic forces are impacting their bottom line right now. Let's start with the United States.
The U.S. market has been a fascinating case study in pricing power for Kirin.
Absolutely. The reports highlight the really impressive performance of Coke Northeast, which Kirin operates in the U.S. And we all know inflation has been a massive headwind in the States recently.
Oh, huge.
But despite that high inflation, Coke Northeast managed to use strategic price revisions that successfully offset flat or even declining sales volumes.
And this is where the nature of the product really matters. When you are selling a staple, highly demanded beverage like soda, consumers are generally willing to absorb a price hike.
They grumble, but they still buy it.
Exactly. If volume drops by 2%, but you raise prices by 6%, your overall revenue and profits still grow.
It's a great buffer. Plus, they recently optimized their U.S. portfolio even further by selling off the Four Roses distillery. But looking across the Pacific to China and the wider APAC region, we see the massive growth engine that balances out this mature U.S. market. The creation of KHSI, which stands for Kirin Health Science International, is their primary vehicle here.
This is a critical area to focus on because China is the world's second largest supplement market. But as you know, entering China physically is notoriously difficult.
Right. I've looked at foreign retail in China before. It's usually a complete regulatory nightmare. If you try to open physical stores, you need local approvals, really complex supply chains, and often joint ventures. Are the reports saying they're just bypassing all that?
Basically, yes, they are using a highly effective alternative, which is cross-border e-commerce, or EC. China has established these special economic zones specifically for cross-border EC.
Oh, interesting.
Instead of building physical stores, Kirin can just park inventory for both FANCL and Blackmores in bonded warehouses. When a Chinese consumer buys the product on an app, it ships directly to them with preferential tax rates and fast-track customs clearance.
That is a massive shortcut. By utilizing cross-border e-commerce, they completely bypass the heavy brick-and-mortar red tape while directly capturing the rapidly growing Chinese middle-class demand for preventative health.
Exactly. It lowers their operational risk while maximizing their reach. It's brilliant.
We also have to talk about foreign exchange, specifically the weak Japanese yen, which is always a major factor for Japanese equities.
Oh, it completely warps the financial statements if you don't adjust for it. On the domestic front, the weak yen significantly inflated their raw material and energy costs.
Operating with a weak yen is basically like running a restaurant where your ingredients suddenly cost twice as much to import, but the tourists paying in dollars think your food is on a massive discount.
That is the perfect way to look at it.
It crushes the supply side, but supercharges the repatriation of foreign sales.
Yeah, and Kirin fought off the domestic cost inflation with aggressive cost-cutting and domestic price hikes. But the flip side was the massive boost it provided when they brought their overseas revenue back to Japan.
Right, from their global assets.
Exactly. This was particularly lucrative for their pharmaceutical arm, Kyowa Kirin, and their U.S. beverage operations. Those currency tailwinds heavily padded their reported yen-denominated profits.
So if you are listening and evaluating this stock, how do you weigh the risks of, say, U.S. inflation against the potential of the Chinese consumer market while factoring in those currency swings?
You really have to look at it as a natural hedge. Kirin's global footprint is specifically designed to balance out these localized risks. They balance the stable cash-generating nature of their U.S. beverage operations against the high-growth, expanding Asian health markets.
Right.
When one region faces a macro headwind, another often provides a tailwind, which really smooths out their overall earnings volatility.
That makes a lot of sense. So we've built the foundation, we know the history, the restructuring, and the global map. Here is where we get to the core of the analysis. How do these regional operations and new health assets actually drive the stock price?
Let's get into it.
We need to map out how their proprietary tech and corporate integration actually lead to wider profit margins and higher earnings.
Let's start with their primary driver, which is R&D and fermentation science. As we mentioned earlier, Kirin isn't just buying generic vitamins and putting them in a new bottle.
Right, they aren't just slapping a label on some bulk vitamin C.
No, they are using that century of specialized brewing biotechnology to create proprietary, patented ingredients. The two major ones highlighted in the reports are LC plasma and ceticoline.
Okay, let's break those down. What exactly is LC plasma?
LC plasma is a specific strain of lactic acid bacteria. But what makes it unique, and this is heavily backed by clinical evidence, is its ability to activate plasmacytoid dendritic cells, or PDC.
Wait, what are PDC?
Think of PDC as the master command center of your immune system. Most standard probiotics only activate a localized part of your immune system. LC plasma activates the control room, providing comprehensive immune support.
Okay, wow. And what about ceticoline?
Ceticoline, on the other hand, is a naturally occurring brain chemical they've learned to synthesize, which targets cognitive function and memory.
So how does inventing a better probiotic translate to higher profit margins?
Pricing power and licensing. Because these ingredients are unique, backed by patents and proven by science, Kirin doesn't have to compete in a race to the bottom on price. They can charge a premium for their own consumer products.
Right, because nobody else has it.
Exactly. But even better, it opens up a highly lucrative B2B licensing model. They can sell the raw LC plasma ingredient to other food and beverage companies around the world. Licensing revenue has incredibly high margins because the R&D is already a sunk cost. High-margin ingredients directly equal higher earnings per share.
But having these amazing ingredients is kind of useless if they just sit in a lab. How are they getting this stuff to millions of people across Asia?
And that brings us to their second major driver, the KHSI integration. This is the operational side of bringing FANCL, Blackmores, and Kirin's Health Science Division into one unified Asia-Pacific platform.
So instead of operating as three completely separate companies with three separate supply chains, they're basically merging the plumbing.
Exactly. Unifying the supply chains inherently cuts costs. But the real financial driver here is cross-selling. I mean, imagine utilizing Blackmore's deeply established pharmacy distribution networks across Southeast Asia to suddenly start selling FANCL's premium skincare products.
Oh, I see.
Or using FANCL's strong direct-to-consumer infrastructure in Japan to push Blackmore's specialized supplements.
They are just running new products through existing, already paid-for distribution pipes.
Precisely. Moving from siloed operations to a unified platform drives massive revenue synergies. They have a stated target of reaching 500 billion yen in revenue for the health science segment by 2035, and they expect 300 billion of that to come from KHSI alone.
That is a staggering target for a segment that basically didn't exist for them a decade ago. And that brings us to the third major driver, which is their pharmaceutical pillar, Kyowa Kirin. The reports heavily feature a drug called Crysvita.
Crysvita is a genuine blockbuster drug. It was developed to treat a rare, debilitating genetic bone disease called XLH, which causes severe bone abnormalities.
And the strategy around Crysvita in the reports is fascinating because they deliberately took a short-term hit to their profits for a massive long-term gain.
Yeah, it was a bold move.
They recently transitioned to direct in-house sales of Crysvita in North America. To do that, you have to build out infrastructure, hire specialized medical sales reps. I mean, it temporarily increased their headcount and their operational costs significantly.
But the mechanics of why they did it are crucial. When you partner with another pharmaceutical company to sell your drug, you obviously have to split the profits.
Right.
By taking full control of the direct sales channel, Kirin captures the full margin of the drug for its entire life cycle. It significantly boosts their long-term profitability and allows them to reinvest way more into their technology pipeline. It's a classic example of investing upfront to capture a much higher lifetime value.
So when we add up the proprietary ingredients, the APAC integration, and the direct pharma sales, what does this actually mean for their financial targets? Management has laid out some very specific numbers for 2035.
The overarching financial goals tying all of this together are ambitious but structured. They are targeting a return on invested capital, or ROIC, of 10% or more. They are aiming for mid to high single-digit EPS growth. And ultimately, they want to hit a 3 trillion yen market cap by 2035.
For you listening, think of ROIC like a batting average for the management team. It tells us exactly how efficiently they are operating.
Yeah, that's a good analogy.
If their ROIC is 10%, it means for every single dollar they invest back into building the business, they're generating 10 cents of pure profit. Every driver we just discussed is engineered to push that batting average higher.
Exactly. But high ROIC and EPS growth are great on a corporate spreadsheet. The real question is, how does that cash actually make it back to the investor?
Right. Let's talk shareholder returns. Because if they're generating all this cash, what are they doing with it?
This is where Kirin's management shows an almost fiercely loyal mindset toward their shareholders.
Yeah.
Let's start with their dividend history, which is just incredible. Kirin has never cut their dividends since they listed in 1907.
Wait, think about that timeline, 1907.
I know.
Through 2 world wars, massive global financial crises, the famous lost decades of the Japanese economy, they never once cut the dividend.
Never. It is remarkably rare for any global company. And they recently shifted their policy to be even more shareholder-friendly. They now target a DOE, or dividend on equity, of 5%.
Let's explain DOE quickly. Dividend on equity means they are paying out based on the actual net worth or the equity of the company, rather than just tying it to this year's net income, which can fluctuate wildly due to things like impairment losses or currency swings.
Right.
It provides a much more stable, predictable payout for the investor.
Exactly right. And on top of that, they formally introduced a progressive dividend policy.
Meaning the dividend payout will only ever be maintained or increased, but never cut.
Yes. And while that sounds great for the investor, what's really important is what it does to the management team. It forces extreme capital discipline.
Oh, because they're locked in.
Exactly. To maintain a century-old streak with a progressive policy, they absolutely must generate consistent, reliable cash flow from their new health science investments. There is zero room for vanity projects or wasteful M&A. Every single investment must yield the cash required to pay that escalating dividend.
And what about share buybacks? How are they managing capital allocation when they sell off those mature assets?
They use buybacks very nimbly to recycle capital. When they have excess cash from divestments, they return it to shareholders. For example, they executed a 50 billion yen buyback in 2022.
Okay.
And more recently, they announced a massive 80 billion yen buyback, which was funded directly by the cash they received from selling the Four Roses distillery.
So they are constantly pruning the tree, sell a mature, slower-growing asset, use that cash to buy back shares, which reduces the overall share count and instantly boosts the earnings per share for the remaining investors.
Precisely. And regarding their balance sheet, management explicitly states they will allow their debt-to-equity ratio to temporarily exceed 1.0 times to fund major strategic acquisitions like the Blackmores deal.
Right.
But they only do it provided they have the modeling to show they can generate the cash to pay that debt back down within 2 to 3 years. They balance prioritizing shareholder returns right alongside responsible debt management.
Okay, let's bring this all together. We've covered a massive amount of ground today. If you are tracking this stock, here are the 1 to 3 year drivers you should be watching closely. First, the successful integration of FANCL and Blackmores under KHSI to hit those regional revenue synergies in Asia.
Definitely.
Second, the continued global rollout and the direct sales profitability of Crysvita in their pharma division. And third, management's strict capital discipline, prioritizing debt paydown while fiercely protecting that progressive dividend streak that dates back to 1907.
It truly is a masterclass in how to pivot a legacy business model while maintaining rigid financial discipline. But I want to leave you with one final thought, pulling from their 2035 vision materials, because it shows where this is all heading.
Let's hear it.
Kirin is projecting a future where health isn't just taking a pill after you've already gotten sick. They see a future involving AI-assisted preventative diagnostics and personalized digital health services.
Okay, but what does that actually look like in practice?
It means moving away from mass-market products to a highly personalized subscription model. They're positioning themselves to provide integrated, always-on digital platforms that track your health.
Wow.
Yeah. Using biomarker feedback, meaning measuring the specific indicators in your blood or saliva, and AI analyzes your current state and prescribes a personalized regimen utilizing Kirin's proprietary, patented ingredients to optimize your immune system before you ever get sick.
As a provocative question is this. Could a company that started by brewing traditional lager in a copper vat in Yokohama in the 1880s actually evolve to become the central AI-driven algorithm managing your immune system and your overall health span by 2035?
It is the kind of transformation that completely redefines how we value legacy companies.
From a cold beer to an AI-managed immune system. Take a look at your own portfolios today. You might just find that some of the oldest, most traditional companies you own are quietly hiding the most futuristic growth engines. Thank you for joining us on this deep dive. Until next time.